Hi, Tamal. Thanks for coming on the show again.
Thank you.
Now, in your recent column, you highlight the issue of treasury losses. Now, everyone was discussing how mark to market losses will reduce the bank's profit. Can you take us to the specifics of the sector and why it did not happen at the scale that everyone was expecting?
Yes, the banking sector was apprehending massive treasury losses that could erode their profits. And in fact, they did reach out to the banking regulator for concessions. RBI was not willing to give it, and rightly so. If you look at the statistics, the balance sheet, how the banks fared, yes, indeed, their other income, so-called other income, which consists of fees income and treasury profit, has come down. But interest income has gone up because credit offtake is much better than the previous few years, as well as the interest also. The interest on loan is rising. So the combination has contributed to the higher NIM, the so-called net interest margin, the difference between the cost at which you lend and the cost of the deposits. And the other part is, of course, that story of less and less provision requirement because your bad loans are going down, fresh slippages are much, much less. So you did not need as much provision as you had been doing historically for the past few years. So these three, the higher NIM and the lower provision, took care of the treasury losses, which is not too big. And indeed, if you look at the subtext or the other income, if you go to the fine print, you will find a lot of banks indeed had made treasury losses, but their fee income is so high that could take care of the losses. This is particularly true of the private sector banks, whereas some of the large public sector banks have shown as much as 80% drop, both quarter on quarter and year on year treasury, the other income losses. Because in their case, the fee income is less. All in all, it's not a bad quarter at all. It's much better than what we had expected. And good run continues.
Now, it's very surprising. You mentioned the credit growth part, and I was checking the numbers. It's over 15% in this monthly bulletin that was released in the last fortnight. Now, this has happened despite interest rates rising. Why do you think that is the case?
So, if you ask any borrower, I'm not talking the retail borrower, but the corporate borrower, interest rate is never a deterrent for credit growth. If it's the cost of credit, and if you see the entire project cost, etc., it's not that high, which can prevent somebody from going to the bank, reaching out to a bank and asking for loan. It's a theoretical stuff, but this exactly is the case. Interest component is a very small component of your overall project cost. I'm talking about corporate. When it comes to retail loan, the EMI is going up, so that definitely we will see the kind of growth we have seen both for home loans, mortgages, and car loan, etc., etc. Probably it will get affected. But as far as corporate India is concerned, a rising credit cost, it will not be a deterrent for. It's historically we have seen that. It's not happening. It's not a problem.
A rise in credit growth should also translate into a rise in inflation. Personal loans are up, credit card outstanding is up 30%. Does it mean an overheating of the economy?
No, we have not reached that stage. If you ask me, I'm not getting into the economics and I'm not the theories, etc., etc. But you have seen contextually, we have not seen that kind of credit growth. You have to also see the lower base. It's not what happened between, say, 2006 and 2008, or rather 2007 and 2009. The credit growth was typically was happening 3 times bigger than the growth in GDP. So we have not reached that stage at all. It's not a question of overheating the economy and a threat to inflation. We have not reached that stage. Having said that, so one of the contributing factors probably of the credit growth is this: some of the banks probably are not as careful and not using their discretion, because the key factor is this: it's a plain arithmetic. if you have a larger basket of loan, then in percentage term, your NPAs go down. So I'm not saying everybody is doing that, but some of the banks are a little more aggressive than how they should approach this. The objective is to show lower NPA, which is very critical. They are doing it, and other part is this. Again, if you ask me, at least some part of the credit is going to various state undertakings. So the states are raising money. These state undertakings are, in fact, one of the incidents that has been discussed in media. So the state undertakings are taking the state guarantee. And I'm told that at least 2 states have been on a verge of default. They are managing it somehow. So it does not necessarily mean that because you have a state guarantee and your quality of loan will be excellent. What happens is these banks, at the moment they say the state guarantee, they keep their eyes closed and say they sign off, not looking at the project. There have been cases where SPVs are being floated and there is no sign of the project, but the banks have been giving loans to that. So my worry is this, while the banks are being very aggressive for their credit growth, the objective is, or rather, it's not that there's a real demand. It's actually the states are raiding through their undertakings to bridge their fiscal deficit, and the banks are some of the banks are not as diligent as they should be. They are giving money freely to bring down their NPA. So that's not a good sign. We may see trouble ahead, at least for some of them.
Because we are talking about interest rates and loans and everything, it is prudent that we talk about the repo rate as well. At a recent Jackson Hole meeting, Fed and ECB indicated further action. Does it mean higher rates in India? And would you revise your September forecast?
I will say that it's not end of the story. They will hike the rate. I mean, the perception was milder, but probably after the Jackson Hole meeting, the market is preparing itself for a hike as much as it happened in the past 2 FOMC meetings. So as far as we are concerned, I think we will see the 2 aspects of it, impacts on the currency side, because as we speak, the dollar index hit 20-year high yesterday, and rupee breached the 80 level yet again during the day trade. Of course, RBI's intervention brought it back below 80. So currency will be, we'll see action on the currency front because it's a safe haven. Money will flow into that. So that's one part of it. Second part of it, yes, indeed, India cannot be isolated, even though at some point Reserve Bank of India claim that we have decoupled ourselves. Our inflation character trajectory is very different. We don't need to bother. Yes, indeed, our inflation is not 40-year high or that kind of some of the developed markets are saying, but definitely inflation is a worry. In fact, in the past few weeks, both governor and one deputy governor has been talking about it's too early to celebrate. So we would see a rate hike. Now, how much will be? My perception is we need to wait for the one more inflation figures will come before the next Reserve Bank of India MPC meeting. You know that it's not in October, it's in September end. So I would rule out 50 basis point hike. I will still stick to 35 more possible than 25. It's between 25 and 35, but my gut feel says we will see a 35 basis hike, which will take the rate at 5.75, provided external circumstances, everything remains the same and inflation is nudging down.
Perfect. Thank you. Thanks a lot for your time. It was great talking to you. Hope to see you again next week.
Thank you.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. vibration that lets success soar high. I will achieve, I will fly high. In SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.